whatever the value given in the balance sheet is called book value. Whatever the value given in the adjustment is called market value. Market value each share is equal to 2,80,000 divided by 50,000 shares. Intrinsic value, net asset divided by number of shares, 6,85,000 divided by 50,000, 13 rupees 7 paisa. Hello my dear students, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to hand Advanced Corporate Accounting 4th semester, Unit 5, Session 3 in favor of valuation of share. In the last session, we already solved the one problem on valuation of share. So, which are the two methods I told in the last session? No, one is intrinsic value method, net asset method, another yield method. Under net asset method, what you are going to do? Total asset minus total liability is capital employed minus preference share capital. There is a capital employed for equity shareholder divided by number of share. Regarding the yield method, first add the profit whatever given divided by number of years average profit. From the average profit, there is no taxation transfer to reserve. There is a profit available to equity shareholder. Capitalize the profit. Profit available divided by normal rate of return. Fourth step, market value of share. Whatever the profit we received by capitalization divided by number of shares. Fair value. The intrinsic value per share plus yield share, both should be added and divided by 2. We'll move on to problem now. So the balance sheet of Ganesh company as on 31/3/2000. So goodwill, building they have given, plant and machinery, stock, investment, cash in hand, debtor, primary expenses. Here 50,000 equity shares of 10 each, 5 lakh. Then general reserve, 50,000 profit and loss account, debenture is a liability, creditor is a liability. On the goodwill was revalued 55,000, building revalued 1,60,000, plant and machinery is to be depreciated rupees 20,000, plant and machinery, the value is plant and machinery 3,40,000. How much depreciated? Depreciated rupees 20,000. Stock is worth rupees 90, debtor are expected to realize 1 lakh. The net profit earned by the company amounted to rupees 60,000, 21/22, 40,000 and only 5,000, 23/24. Every year 20% profit transfer to reserve, a return of 10%. Net asset method. Particulars. Book value or market value. Book value means whatever the value given in the balance sheet is called book value. Whatever the value given in the adjustment is called market value. Here, whichever is more is not there. It is not there. Either you have to take the book value or if the market value is given, you take the maybe more or less. I will give you an example like this. Building 1,20,000 is the book value. Here in adjustment is only 1,10,000 means you have to take only 1,10,000 only. Maybe more or less is not considered. If the market value is given, then you have to take only the market value. First one, goodwill. How much goodwill valued? 55,000. Then building, Buildings, 1,60,000. This over. Plant and machinery is to be depreciated rupees 20,000. Plant and machinery. What's the original value? 3,40,000. Depreciation minus 20,000. 3,20,000. This is depreciated by rupees 20,000. Machinery is to be depreciated by rupees 20,000. Stock 90,000. 90,000. This one. Debtor are expected to realize 1 lakh. Debtors 1 lakh. Which is left over, you have to see that goodwill has been revalued. Okay. Building over. About the stock, 80,000. This over. This over. Investment, 50,000. Investment 50,000. This over. Debtor over. Cash 30,000. See that all the items are over. Goodwill over, building over, machinery, stock, investment, cash in hand over, debtor over. Primary expense should not be taken. Should we add the figure now? 55,000, 160, 3,20,000, 90,000 plus 1,80,000 plus 50,000 plus 8,85,000. 8,85,000. Liabilities. Liabilities. 8% debenture. One lakh. Creditors. 1 lakh. It becomes 2 lakh. Net assets is equal to total assets minus total liabilities. $8,85,000 $8,85,000 minus 2 lakh, your net asset become 6,85,000. Intrinsic value net assets divided by number of shares. This is 6,85,000 divided by number of equity shares, 50,000. $13.1. So this goes to this one. This is as per net asset method. Then Yield method. Total profit for how many years? 1 year, 2 years, 3 years. 3 years is equal to 60,000 plus 40,000 plus 5,000 is equal to 1,05,000 divided by 3. 105 divided by 3. 35,000. Profit to equity shareholders average profit no taxation, transfer to reserve, what's the percentage? 20%, 7,000 deduct 28,000 profit available. Third step, capitalization is equal to 28,000 divided by normal rate of return 10%. $2,80,000 market value of each share is equal to 2,80,000 divided by 50,000 shares. 280 divided by 50, 5.6. $2,80,000 divided by 50,000 means 5.6 rupees. There we got 13 rupees and paisa. Fair value at first one 13.7 plus second value 5.6 whole divided by 2. This is 13.7 plus 5.6, 19.3 divided by 2, 9.65. That is the fair value. So how to do that now? First one, net asset, book value or market value. So goodwill 55,000, building 1,60,000, machinery 3,20,000, stock 90, debtor 1 lakh, stock 80, investment 50, cash 30,000. It becomes 8,85,000. Liability 8% debenture, creditor 2 lakh. Net asset is equal to total asset minus Total liability 8 lakh 85 plus 2 lakh means 6 lakh 85,000. Intrinsic value net asset divided by number of share 6 lakh 85 divided by 50,000 13 rupees 7 paisa. Now profit method total profit for 3 years 60,000 40,000 5,000 1 lakh 5,000 divided by 3 is 35,000. Profit to equity shareholder average profit is 35,000 minus transfer to the 20% is 7,000. So difference is 28,000. Capitalization profit 28 given normal rate of return 2 lakh 80,000. Market value of each share 2 lakh 80,000 divided by 50,000 5 rupees 60 paisa. Fair value 13.7 plus 5.62 19.3 divided by 2 is 9.65. So I've gone through the problem very detailedly. Here only thing point to be bear in mind, here the values given here as per the problem is very less. So regarding the profit, no, they have given 60,000, 40,000. In third year is only 5,000. The profit has come down. That's why the value of the share has been come down here. So every year how much transferred here? 20,000. Normal rate of return is 10%. Yeah. Procedure. First is either the book value or the market value, or whatever the value given is given. If the value of the market value is not given, we have taken the book value. Totally it becomes 8 lakh 85,000, 2 lakh gone means 6 lakh 85,000 divided by number of shares are 50,000 because the value of the share is only 10 rupees. Here problem 50,000 equal share of 10 each is there. So the value will become very less 13.7. Here come back to profit. Total profit for 3 years 60, 45, 1 lakh 5 divide 35,000 profit to equity shareholder. Average profit minus transfer result 20% 7,000. Balance is 28,000. Capitalization of profit 28 divided by 10 into 100 2 lakh 80,000. Market value of each share 2 lakh 80 divided by number of share is 5.6 will come there. Fair value, add both. Fair value 13.7, 5.6, 19.3 divided by 2, 9.65. Hope you understand that. We have solved the problems very slowly. 2 problems have been solved. One more problem we are going to attempt in the next session. Till then, goodbye. Meet in the next session.